Hello, everyone, and welcome. My name is Joe Pickart, and I am coming to you live from Milwaukee, Wisconsin, the home of the 2021 NBA champion Milwaukee Bucks. You had to let me have that because it's the first time in 50 years we got to say that. In any event, welcome, and thank you for joining us today for our presentation on understanding the new and improved dependent tax credits. I am a partner and the leader of Husch Blackwell's national tax practice. My own area of expertise is state and local tax controversy and litigation. When necessary, we represent clients from all industries, both the nonprofit and for-profit sectors. Before we get started today, I would like to cover a few housekeeping items. At the bottom of your audience console, there are multiple application icons for your use during today's program. If you have any questions during today's webcast, please submit them via the question box. We will try to answer all questions during the course of our presentation, but if we do run out of time or if a fuller answer is needed, we will certainly follow up with you individually. A PDF of today's presentation is available in the resource folder. And for those of you who are interested, this program has been approved for legal education hours. To report your hours, click on the CEU icon at the bottom of the screen. A certificate of attendance, including course number, will be emailed to you tomorrow along with a recording of today's webcast for you to watch and share with your loved ones. Toward the end of the program, we ask that you please be sure to complete the short survey. We use your feedback to improve on our own presentations and to identify other areas of law in which you may be interested and in which we may provide a webinar in the future. Before we begin today, I think it might be helpful if we provide you with a little bit of history of how this webinar came to be. Several months ago, we received a request from our friend Amy over at St. Francis Community Services in the Catholic Legal Assistance Ministry. Based in St. Louis, St. Francis walks hand in hand and provides guidance to its vulnerable neighbors to create opportunities, to build resiliency, and to advocate for justice on behalf of those it serves. As part of this mission and under Amy's guidance, St. Francis provides legal assistance when needed. And it's in this context where Amy reached out to us and said, can you provide some guidance to us as we help others in understanding these new rules and the rule changes with respect to the tax credits? And so that's why we're here today. So I want to thank Amy and her excellent team over at St. Francis and welcome them and the rest of you as well. That's pretty much it for the housekeeping items. And today, as I said, we'll be talking about, who is eligible to claim the credits and how the credits work and answer some of your other really kind of detailed questions. I'm going to serve as your moderator today, but the real big hitters are the two others you see on the screen and who I'm very pleased and honored to introduce, Bob Romashko and Megan Christopher. Bob is a partner at the law firm of Husch Blackwell with me. He is a member of the tax team. His main focus is in tax controversy with a specific emphasis on federal tax controversy. Notwithstanding his youthful looks, Bob has appeared in about 300 cases, both on behalf of the IRS and then some when we were able to grab him from the IRS and have us join Husch Blackwell. Bob works in small business and Bob worked in the small business and self-employed division and constantly had cases that involve these types of credits and specifically the credit at issue. So Bob provides some very practical insight as to what the IRS will look for in terms of the type of evidence needed to prove the eligibility for the tax credit. I'm really pleased to introduce Megan. It is very unusual. In 30 years I've been practicing, I have never asked a legal intern out of our summer program to assist in a presentation. So this is a first for us. Megan was the person that did all of the real hard work behind the scene and did all the research and all the drafting of the underlying work that we need to present today's seminar. Megan is a rising third year at the University of Wisconsin Law School and is working as a clerk here in the Milwaukee office, also a proud Milwaukee Bucks fan. At Wisconsin Law, Megan is a member of the Business and Tax Law Association, an articles editor for the Wisconsin Journal of Law, Gender and Society, and works as a research assistant in the Business and Corporate Law Department. Prior to law school, Megan worked as an analyst at a financial law firm in Chicago, and she is a proud alumni of Indiana University's Kelley School of Business, where she studied finance as an undergrad. She looks forward to practicing tax law in the future, and we look forward to being involved in Megan's career as well. So with that, I would like to turn it over to Bob, who with Megan will present today's seminar. So Bob, take it away.
Thank you, Joe. And yeah, so just to walk through the agenda briefly, Joe just covered the welcome and introduction of presenters, but I want to talk, we're going to have a little bit of an overview of what we're covering and why it's important. And we'll get into then the child tax credit, the mechanics of that, the amounts and the related credits that you should probably be aware of, although our focus will be on the child tax credit itself. Then we'll talk about the advanced child tax credit payments. That's one of the new features for 2021, the payments that started hitting last week, and how to go about making sure people are properly signed up, whether people should be properly signed up, and similar issues. We'll also talk a little bit about, there's some reasonably complicated tie-breaking rules for the child tax credit, so we'll cover that. As well as how to go about substantiating that a taxpayer is entitled to the child tax credit. There are some further issues we'll cover, as well as some questions that came in before the program that it didn't fit into our outline otherwise, but we want to make sure to address. And then we want to allow some time for questions and answers. And on that point, I can't stress enough, you have the ability to send us questions anytime. These are complicated issues. I mean, there's just no way around it. It's probably not entirely an accident of our system that the people who are sometimes in the least position to really interact with the IRS, have a bunch of complicated criteria they need to satisfy to get certain types of relief. There are going to be a lot of fact-specific questions. There's no way our outline possibly addresses all of them. And if you think of a question or a scenario that, you've run into or that you have, and you want us to address it, just use that question box. We want to make sure we get to those because there's just no one-size-fits-all solution here. You understand what I mean, I think. There's no one-size-fits-all presentation that could possibly answer every one of your questions in 75 minutes. So that said, I wanted to start with just an overview of the program. And the child tax credit, no doubt you've seen it in the news. This morning, Vox.com had a really nice long-form article where they interviewed 3 people discussing what the child tax credit meant for them, the changes to it. And specifically the advance payments that started this July. And it's significant for a lot of people. You see the headline here on the slide, 35.2 million families just got their first monthly payment. And those payments can be significant. Childcare can potentially run, it's a huge expense for people. And getting money into people's hands throughout the year it could potentially be a major anti-poverty measure. And on an individual level, it can make a big difference in people's lives. So that said, just to discuss a little more of our objectives, and I want to stress what Joe said. The genesis of this program was we were originally intending to present to Catholic Legal Aid Ministries regarding, how to best serve their clients. but we decided to open up the program to the general public, and we want to make sure we address, if you're a legal aid provider and you're serving clients, we want to give you the information you need. If you're on because you're curious about the credit for your own purposes, we want to make sure that you're also getting the information you need. And if you just so happen to be that lawyer that everyone in your family calls with questions, we want to make sure that, again, you've got the information you need. So I hope we're serving all of those objectives. And again, to the extent that you have a question that, isn't answered in the course of the program, or something we say prompts a question, please feel free to ask. And this is important in part because it's a recent change in the law. And frankly, I think that one thing we found in preparing for this program is I think the IRS has done a pretty good job in standing up resources for taxpayers on this, both in terms of these online portals that the IRS has put up and in terms of some pretty detailed FAQs on their website. At the same time, they haven't thought of everything. That much is for sure. There are always going to be situations where it's not clear what to do or what the right answer is. And, that's just a function of being, 4 months out from this law being passed. So there's that. As we discussed a little bit already, this is important because the payments are significant for many of the people getting them. The phase outs for the regular child tax credit, and we'll talk more about that in a minute, are fairly high, and there are definitely going to be people getting money deposited into their accounts the rest of this year who don't necessarily need the money month to month. But there are also going to be a lot of people, especially if you're in a legal aid type situation and these are your clients, where that money is going to make a big difference. And, hundreds of dollars of extra cash flow a month are, the difference between affording things you need or not, or even, being able to take the kids on a trip to the zoo or not. I saw a reference to that in one of the articles I read preparing for this. And, it's also important because it's an opportunity to get money in hand early. These are, as we'll discuss on the advance payments, these are a credit against the 2021 refund. There's a saying I've heard in tax planning, which is a tax deferred is a tax avoided. The opposite is also true. Getting money in hand now is usually virtually always better than getting money in hand next year. So it makes a big difference. With that said, I'm going to turn it over to Megan, who's going to talk a little bit about the child tax credit itself and sort of the mechanics of that credit. So take it away, Megan.
Thanks, Bob. Yeah, I'm just going to give a brief, well, I guess not so brief overview of both the requirements and the different income thresholds that were put in place to receive the child tax credit specifically. So the child tax credit is a general credit that taxpayers can receive that reduces their tax liability dollar for dollar. And unlike in previous years, for 2021, the tax credit is now fully refundable, which means that if the credit reduces the taxpayer's liability to zero, the balance of the credit that taxpayer is entitled to is refunded to them. So the most important question that I'm sure all of you are interested in learning about today is who exactly is eligible to claim the credit. The key word in determining who is eligible really here is qualifying child, because it's parents and guardians of qualifying children that are eligible for the credit. So in the context of the child tax credit, a qualifying child means, first, a person who's under the age of 18, a person who's a child, stepchild, foster child, brother, sister, or step-sibling of the taxpayer, or any of those individuals' descendants. So, for example, the taxpayer's grandchild could potentially be a qualifying child. Third, the child must have provided less than 50% of their own support throughout the year. Fourth, the child must have lived with the taxpayer for at least 50% of the year. And finally, the child must be a U.S. citizen. So even if the taxpayer meets the requirements of having a qualifying child, the taxpayer must then look to the income limitations because the credit is phased out based on certain income thresholds. So the 2021 changes to the child tax credit sort of bifurcated it into two pieces. So first, we have the increased credit amount for taxpayers with certain modified adjusted gross income amounts. And then second, we have the regular credit that existed before these changes all took effect. So first, for individuals with incomes listed on the slide there under the increased amounts for 2021 section, so $75,000 for single filers, $112,500 for head of household, and then $150,000 for married filing jointly taxpayers. The credit is worth $3,600 per child under the age of 6, and then $3,000 per child under the age of 18. The credit is then reduced by $50 for each $1,000 of income that's over these threshold amounts. So then if the taxpayer has income above these threshold amounts for the increased credit, the taxpayer then must look to a different set of requirements to determine if he or she will get the original credit amount. So whether the taxpayer gets the original credit, which is $2,000 per child, that depends on whether their income is at or below $200,000 for single filers or $400,000 for joint filers. So if the income is above either of these amounts, the $2,000 credit amount is then again reduced by $50 for each $1,000 of income over those thresholds. So I know that's a little bit confusing with the two different set of requirements. So I thought it would be helpful to just illustrate it with a brief example. So say there's a taxpayer who's married and filing jointly with a modified adjusted gross income of $175,000. And the taxpayer has one qualifying child, say age 13. So since the taxpayer is over the $150,000 income limit for the increased amount of the credit by $25,000, intuitively you might think, based on what I said, that the credit would be reduced by $1,250, which is that $50 for every $1,000 over the limit. But the taxpayer's income is well within that $400,000 income limit for married filing jointly taxpayers under the original credit amount. So this taxpayer would actually be entitled to a credit of $2,000, again, assuming that all of the other requirements for a qualifying child that I discussed previously are met. So I'm going to pass it back to Bob now to discuss the other credits that are available or could be available to clients that you might be working with.
Thanks, Megan. And I think just a couple other points on that. To the extent that that seems a little confusing, that you've got these two regimes, the increased amount and what we're calling the regular credit, I think it's important for people to understand that that's pretty much just an artifact of the legislative process. The increased amounts, rather than being structured as replacing the regular amounts, are a separate section and just with its own test. And so when Congress amended the child tax credit, they didn't just change the amounts or the face outs, they added sort of a parallel credit. And in figuring out what you're entitled to or what any taxpayer is entitled to, whether it's you or your client, you look to both tests and you get the higher of the you get a credit for the higher of the two amounts. And the one other point I wanted to make, just thinking about it, is I don't know for sure if everyone knows the difference between a credit and a deduction, but very briefly, a tax credit is a dollar for dollar, credit or offset against tax liability owed. So it's applied at the very end of the process after you've figured out what tax is. And as Megan mentioned, the child tax credit for 2021 anyway is fully refundable. So every dollar that you don't get, that you don't have tax to offset, you simply get refunded. And Megan, I think if I didn't think to look at this ahead of time, but the rules other than for 2021, I believe the child tax credit was at 50% refundable if you weren't over a certain income level. Is that correct?
It was refundable to a certain extent. I'm not sure if it was 50%, but it was only available to taxpayers with fairly low adjusted gross income amount. So it certainly wasn't available to everybody.
Got it. Okay. So that's the other point I just wanted to make on this issue. So that said, moving along then to the child tax credit related credits. One of the questions we got in preparing for this program was whether what other programs, legal aid, and similar organizations should be aware of in serving their clients. The biggest of those that you need to be aware of, sort of related to the child tax credit, but different, is the earned income credit. And most of the information on this slide concerns that credit. So you can see over to the right, we've laid out the 2021 income thresholds, which depend on the number of children or relatives that you have in the household. The earned income credit is a little different than the child tax credit in that it is it is a credit against earned income, and so, or that depends on earned income. And what that means is wage income, basically, wage, salary, as opposed to passive types of income like investment and similar. And while I was planning on taking questions in turn at the end, I saw that a question popped up just asking what MAGI, which is used on the slide, is. The prior slide is. That stands for Modified Adjusted Gross Income. It is mostly just the adjusted gross income line on a taxpayer's tax return with a couple of subtractions or additions. But it's generally pretty close to that. It's not that different from AGI. Off the top of my head, I couldn't speak to exactly what the difference is. We could address that later in the program. But I just wanted to clear up that confusion now because I think we'll be using the term again. So that said, going back to the earned income credit. So the most important thing is you need to have earned income. The Earned Income Credit's an anti-poverty program, and it's one of those anti-poverty programs that is designed with a hook for better or for ill that is supposed to encourage people to work. And they do that by saying that you have to have earned income to get this. These dollar thresholds depend on what your earned income is. If you have investment income of more than $3,650, you can't qualify for the earned income credit. It's also important to note that this is in addition to the child tax credit. It's not an alternative to it. As you can see here, if you have 3 or more qualifying children, and we'll talk about what a qualifying child is in a second, it can be up to $6,728 in payments, which is significant. There is also something that you should be looking at for your clients, depending on their circumstances, the Child and Dependent Care Credit. That is a credit for parents or guardians who have children and need to pay for care for them in order to be able to work or to look for work. It's important, I think, on that one to note that, it's more limited, but it's something you should be looking at because people do incur childcare expenses. However, those need to be childcare expenses that are not paid to a member of the immediate family or a sibling. You can't just take the credit if you're paying your, hypothetically, your other son or daughter to watch the remaining children. So that's the long and the short of that one. These credits are not really the focus of the program today, but if you're advising clients in a legal aid setting on the child tax credit, you should also be looking out to see if they qualify for these because they can be fairly significant on their returns. Okay, so next I want to talk a little bit about the advance payments. So that is sort of the most interesting, at least, feature of the expanded child tax credit that the Biden administration passed. So this is, as far as I'm aware, and certainly if you look at the IRS's press releases on it, they will claim that it's unique as far as it being a method of putting money directly into people's bank accounts throughout the year. I think the first thing to note, though, is for the moment, it's only a 2021 program. It was passed as part of the coronavirus relief bill this spring after the new administration and the new Congress were seated. And for now, it's a one-year program. However, the Biden administration has proposed making it, parts of it permanent and parts of it extended through 2025. So their proposal would be to make the part of the credit, or part of the changes that make the whole credit refundable permanent, while making the expanded amounts extended through at least 2025. Those could be extended further later, but I think that's as much as anything else, a 10-year budgeting trick where they score the bill by its cost over the course of 10 years. So only extending it 5 years in a chunk results in a better Congressional Budget Office score for the bill. But so if that's passed, and of course the Biden administration and the Democrats control Congress and the presidency, so you'd probably think that it would be likely. You can expect that these changes will extend through at least 2025 in full. The one other thing, because one of my first questions was, let me talk about the remaining changes here. So the other thing here is these are advance payment, right? Half of the total payment for 2021 to be paid in, I'm sorry, we made a mistake on the slide here. Half of the total payment for 2021 will be paid in 2021. Normally, of course, you get your tax refund in the year after the tax year when you file the return. But yes, so this is, otherwise you would, these are payments of funds that you would normally see in 2022 being paid in 2021. And we laid out the payment schedule, but it's generally the 15th of every month unless that falls on a weekend, in which case it's paid sooner. And the first payments, of course, went out last week. I have seen a few articles on people who are frustrated because they haven't received payments that they're entitled to. So needless to say, with, again, I think that number was 35.2 million families receiving the payments. Not surprisingly, it hasn't been flawless, although it seems to me that overall it's been pretty smooth. But that brings me to the other point about if this is extended, which is part of me wondered if the reason the payments were starting in July was because there was some, the IRS needed time basically to get the funds into people's accounts and figure out a system for doing it. That doesn't appear to be the case. The proposal that's currently out there is that it would continue to be a system of payments in the second half of the year. And if you think about the mechanics of this and the reason for the advance payments, that makes some sense, because the idea is that half of the refund you would see in the year you filed the return is being paid out ahead of time. So when you file the return in early, when you file, or your client files a return in early 2022, they will get half of the credit then, which can be a very significant amount of money for them. And then starting in July, they would get payments for half of the next year's refund over the course of the rest of the year. So I think the goal there is to spread out income while still giving people a fairly big hit on their tax returns, or on their refunds when they file their tax returns. And that there may be a political aspect to that. They don't want to take away the impact of people getting a big check when they file their tax return if they owe money, or if they are owed a refund. But it may also be practical, because on some level, a bunch of that money being paid out in the early half of the year, and it's the second half of the year where the revenue stream is really needed. So that brings us to sort of the mechanics of getting this and how to go about using it, the Irs Portals. So let's talk first about how the IRS determines that you are eligible for this credit, because in a way they're predicting the future, what's going to be on your 2021 return. So they look at the sources laid out here on the slide in order. So first they look to the 2020 return. They will look to the children you claimed as dependents on the 2020 return. I didn't put a Form 1040 in the program materials, but if you look at a Form 1040, the individual income tax return, there's a table where you lay out the names of the children, their social security numbers, and dates of birth. And so from that, they know the age, they know whether anyone else has claimed the children. And if you have someone on your 2020 return as a dependent and they're eligible for the credit, the IRS will treat them as being eligible for the credit unless they would have aged out of it during the course of the year. They're going to make sure that the child would be under 18 or under 6, depending on the amount that we're talking about, and base the payment on that. If for some reason you didn't file a 2020 return, you could have extended the due date and it wouldn't even be due yet. Or there may not have been a 2020 filing requirement. The IRS will look to the 2019 return. And, one thing, I just made myself think of this, but I think it's important. A lot of people who are eligible for the credit, especially the people who most likely need it most, may not have return filing requirements. They may have little or no income. And even if they do have income and technically have a filing requirement, the odds are pretty good that they're not going to owe anything. And so they may not be filing returns. But for credits like this, it's important that you file returns, because you don't get the money if you don't file a return. And so, if your clients are saying, oh, we don't file a return because we're not going to owe the IRS anything, you need to take a look and run some numbers and say, oh, hey, maybe you ought to be filing a return because the government actually would be paying you money if you did. So I just wanted to mention that because it's important, and that's actually something Joe mentioned in the introductions that I had worked on a fair number of these cases, and there were definitely cases I had where people were non-filers, and when that happens, the IRS tries to estimate based on what little information it has, what the person owed. And when people got around to actually giving us the details of their return, it turns out that, well, they were right that they didn't need to file a return in the sense that they didn't owe the IRS any money, but that they were actually owed money. So it is important. But if someone is a non-filer, they can also use the Irs Non-Filer portal to report their dependents to the IRS so they can start getting the advance payments for 2021. That said, to get the remainder of the credit next year, they will need to file their return. And in theory, and I don't know that the IRS has worked this out yet, and Megan, please jump in if you've seen something on this. But in theory, if they don't file a 2022 return, the IRS could say, well, you haven't shown that you're entitled to the credit. You haven't claimed the credit technically. And so we are asking for it back. I don't know if you know if that's correct or not. I haven't seen anything myself, Megan.
I haven't seen anything either.
Yeah. So I that's a theoretical risk. I don't think that the IRS is going to be very aggressive in trying to claw these back where people don't file returns, because it sort of defeats the purpose. There are other situations where I think they'll be very aggressive in trying to claw them back, but we'll discuss that in a minute. But the long and the short of it is, for purposes of where we are in the discussion right now, that if someone didn't file a 2020 or 2019 return, they can go onto this non-filer portal, and that should be linked in the PDF copy of the program materials you, I think, have available to download now, and and that you, if you don't have available to download now, will be sent to you tomorrow. There are a couple of other IRS portals that practitioners and individuals need to be aware of. One is an eligibility portal that will allow you to actually enter your information to determine whether you're eligible for the credit. Obviously, some people will know if they were eligible for the credit or not, or at least whether they got it, based on whether it hit their bank account on July 15th. But if it didn't and people are wondering why, they can use that portal to try and figure out their eligibility. The other thing, and this is probably more important for clinics and individuals to know about, is there's an update portal. There's a couple of functions for this. The first is the basic, if the IRS doesn't have current direct deposit information for you, you can use this to update it if you've switched banks or you weren't getting direct deposit for prior refunds and they don't have it. You can use this to tell the IRS where to send the payment. If they don't have direct deposit information, the advance payments will be sent by check in the mail. That obviously slows things down. It's probably not ideal. The other thing you can do, and we'll talk a little more about this later, you can use that update portal to opt out of the advance payments. There are reasons you might want to do that. Probably for most people who are clients of a legal aid clinic, they don't fall into that camp. But on the other hand, everyone has personal preferences and needs, and it may still prefer that. I believe you can also use the update portal. I don't have any screenshots in front of me, but I believe you can also use it if your number of dependents changes in a year. For example, you had a child in 2021 who you'll be eligible to claim. You can report that to the IRS on that so they calculate the credit correctly. And Megan is nodding to me, so I think she's nodding to me. She's certainly nodding. So I think she's agreeing that you can, in fact, do that. The other, this other bullet point we've got on the slide, other resources for practitioners and taxpayers. When we send out the program materials, there'll be a couple of PDFs that are included. One is a handout for IRS quote unquote partners, which I think is intended to be both taxpayers and people assisting taxpayers, but detailing some of the nuts and bolts of going about the process of getting the credit, and answer some basic questions. It's not going to give you everything. The IRS does have a very detailed FAQ on their website that probably gets into some of the more nuanced situations, but it's helpful as a primer on what you need to be doing and what the concerns are. The other thing that we'll be sending out is the IRS does have a pretty good walkthrough, which does have screenshots of how to use the, I believe it's the non-filer portal. No, it's the update portal. Is that correct, Megan?
I'm not sure. I'll double check that right now and let you know.
Yeah, I apologize. Whichever it is, though, we will include it, but those are available on the IRS's website as well, and sort of walks you through the steps to use that portal and some of the common issues. I will say from, about a dozen years of tax practice at this point, that these are surprisingly good and surprisingly detailed resources for the IRS to be able to put together in the span of a few months. I am sure they are not perfect because the IRS is, and this, I say this with no judgment, but is a massive bureaucracy with, all kinds of legacy computer systems and things like that. And I'm sure that there are holes and bugs, but they've done a pretty good job standing up these systems. So turning to the next section, some of the implications and consequences of the payments. So this is sort of a pro-con list, honestly. Obviously, the big thing about the advanced child tax credit payment is it helps taxpayers get cash in hand earlier. I laid out an example here. Megan had a different one earlier, but the point is a single parent making less than $75,000 with a 2-year-old and a 5-year-old would get $7,200 in total credits. If these weren't paid in advance, that would potentially be a $7,200 credit in 2022. If they filed April 15th, they'd be getting it in May probably. On the other hand, this way, under the advanced credit system, they're potentially getting a $600 a month deposit or check every month the rest of this year. And then we'll get a $3,600 refund. So that can defray some current expenses, potentially make life easier in 2021. As mentioned, though, they don't have to take the advance payment, or they may not get it if the IRS doesn't have current information, at which point they will get the $7,200 next year anyway. So, the consequences, it may seem kind of obvious that, the trade-off is the lower 2021 refund, which will be payable in 2022. I think it is important to note that that could result in some people owing the IRS money who otherwise would not owe the IRS money. But that's mostly going to be at higher income levels. As mentioned, the genesis of this program was legal aid clinics. Most legal aid clients are not going to be in that boat. I don't want to say all of them because, people's circumstances can vary. But certainly, something to consider if someone is self-employed and paying self-employment tax, where they're making quarterly tax payments, someone in that boat potentially is going to, have to pay more in estimated tax payments than they otherwise would have if they don't take this credit. You can take the opt-out if you want. One thing to note is that at the moment, at least, the opt-out is permanent. You certainly can't opt back in for 2021. The way it's worded by the IRS, it may be permanent for the rest of your life. I kind of think that if the credit is extended, the IRS will probably, there's no legal requirement that the opt-out be permanent. I think that's just how the IRS has set up its systems at the moment. And right now it's a 1-year program. I would think if it's extended, it's likely that the IRS makes that yearly, but you do run the risk that you are forever opting out of the advance payments by doing so once. Okay, so now we get into some of the thornier issues, which are the IRS's tie-breaking rules. So we spent a bunch of time earlier talking about what constitutes, or who constitutes, I suppose, a qualifying child. And apologies if you can hear barking in the background. This is the fun of not having returned to the office for everyone yet. But there are a couple of issues that come up. One is that under the rules that are set up, multiple people, especially usually parents, can technically qualify for the credit even if they're not joint filers. For example, if you have, just to give you a really basic example, and this is probably not the most contentious one, but if both parents live together but are unmarried and filed separate returns, and they otherwise, are raising the children as, like a regular nuclear, I don't want to say regular, but as a nuclear family, mom, dad, 2 kids, they each live with the children full year. They each provide support to the children, although support is not an element. And they are each a parent, assuming the other requirements of, U.S. citizenship and stuff are met. They both have perfectly legitimate claims to deducting or to claiming the child as a qualifying child and claiming the credit. So, there you have the need to sort of break the tie where they both have a claim. You also have the issue where, custody changes during the year, and maybe, if there's a period of, cohabitation or something like that, multiple parents can, or multiple guardians, could potentially claim the child legitimately. And so the IRS has prescribed a series of tie-breaking rules. Because I guess I didn't say this out loud yet, but the rule is any given child can only be claimed on one tax return, even if more than one person meets the requirements. There's no splitting of the benefit. The IRS is going to pay it out once per child. And you are required to give each child Social Security number, and the IRS absolutely runs those through its computer system and matches them. And while I'm sure they are not perfect, will kick out duplicate claims for credit on the same child and won't pay them out. They'll pay them out once. And by the way, when I say no splitting of the benefit, so the IRS's philosophy is what people agree to do with tax money once it's refunded to them is not generally the IRS's business, except to the extent that it creates income that needs to be reported on future returns. If the parents agree to split the credit among themselves, that's fine. You just can't bring the IRS into the arrangement. So one of them needs to cut a check to the other. The IRS is not going to split it up among them. So that brings us to what these tie-breaking rules are. And they're relatively simple, and I think they make sense in most situations. There's always some edge cases where they don't. But first is if 2 people qualify, but only one person is is a parent, the parent gets the credit. Simple enough. Second, if both parents are eligible, the parent who lived with the child more of the year gets the credit. And if that's a tie, then the credit goes to the parent with the higher adjusted gross income, which these rules predate the changes making the credit fully refundable. So when they were put in place, the notion was more credit would be paid out by doing that. That's no longer true, but it's still the rule. And then if no parent can claim the child didn't live with the parents during the year, say, or the parents are deceased, the person who does meet the requirements and has the highest adjusted gross income gets the credit. And then if a parent can claim the child, but no parent does, the child is treated as a qualifying child of the person with the highest adjusted gross income who meets the requirements, but only if that person's adjusted gross income is higher than any parent who could claim the child. And there the notion is that if the parents could claim them but have a higher adjusted gross income, I guess the parents ought to be claiming them. But that, again, that only will come up if multiple people are claiming the child. So if two non-parents are claiming the child, it is the only time the IRS is going to apply that rule. So moving on then to substantiating this. So the thing to understand, and this is where I think a lot of people get a little surprised in dealing with the IRS, and I've seen this from attorneys too, not just individuals, is going about proving up to the IRS that you are entitled to something. And the general rule is that credits and deductions are matters of what's called legislative grace, and taxpayers must be able to substantiate that they're entitled to them. And the notion there is that not to get too far into the weeds of sort of the theory of income tax, but the idea there is that the default rule is you're taxable on all of your income. And because everything that reduces the amount that you're taxed on is an exception to the rule, you as the taxpayer, you as the taxpayer's attorney, are responsible for proving up that you are entitled to it. And, this comes up, substantiating your right to the credit comes up in a couple of situations. One is if those tiebreaker rules need to be applied. So ordinarily what's going to happen is if two people claim the same child, the IRS's computers will kick out those returns. I think they will, this can vary a little bit on how it actually happens, but I think sometimes the IRS will actually refuse to accept the return and ask for the return to be filed in paper. I think sometimes the other way it happens is the IRS simply disallows the portion that has to do with the child and sends a notice saying, basically, prove you're entitled to take this child. But even if you're not in a situation where multiple people claim the same child, you can still get picked up in an audit. And I don't want to get into too much detail on how the IRS selects things for audit. If you want to hear more about that, there's a program that I think is probably still available on our website where we talked about this more. But the long and the short of it is the IRS audits not just because it finds a problem with a return, but they audit a certain percentage of returns randomly, simply because part of their mission is ensuring compliance with the tax laws, and they'll do part of that through a random sample. And so even if someone's doing everything right and has no reason whatsoever to think that they can't claim the child, they could still get picked up in a compliance audit. I will also note that I think that the statistics, while I don't have them, I didn't pull them for this program, but I think do bear out that the IRS does a surprisingly high percentage of its auditing on people who claim the child tax credit or the earned income credit. And I would never discourage anyone from filing because they should be concerned about an audit. That's not for these credits. Because they should be concerned about an audit. That's not my point at all. But I think the point is just to understand that people really do need to make sure that they have the documentation they need to prove that they are entitled to the credit, because they may be asked to do that at some point. And so what is that documentation? Well, the IRS actually puts out a form that does a very good job of detailing what they would like to see. That's not to say that these are it's called Form 14815. And we've reproduced it on the next slide. I don't know how clear that's going to be on your screens, but it's also linked from the PDF of the PowerPoint you'll get. I want to be clear that what's on this form is a set of supporting documents the IRS would like to see. It's not by any means the be-all and end-all. And there are some things the IRS doesn't like to just take people's word on things. But on the other hand, there are some elements of the credit, which if you think about them, there's no real, things like, are you this person's parent, right? That the IRS realistically is not probably going to say, well, if we can't see the birth certificate, we're going to deny this forever. But, walking through what the IRS would like to see on each of these, sort of prove up a taxpayer identification number. They ask for a social security card. Hopefully people will be able to produce that because that's a harder one to come up with any sort of acceptable substitute for. But if, someone doesn't have a social security number let me back up. There should be a social security number for the child. That's generally, that should be handled at birth. I'm sure there are people who should have them that don't, but by and large, that should be taken care of. And I'm not going to, certainly not prepared to, go into the details of how you go about getting a social security number where someone didn't have that taken care of at birth. But if someone's children don't have social security numbers, you should be looking into those procedures. But if they're, it is actually a good idea though to see when someone's taking the credit, if they have these documents, if they don't have a social security card, you can request a replacement from, I believe it's, excuse me, I believe it's SSA that you request a replacement card from. That's the Social Security Administration. Citizenship and residence in the United States. So IRS lays out rental property lease. I will tell you that, Joe mentioned I worked or have appeared in about 300 tax cases. I would say probably about 50 of those are earned income credit and child tax credit type cases. Not the lion's share by any means, but I probably always had one active or more than one active while I was working at IRS. I don't know that I ever saw, I would always ask because it's on the IRS's list, that for rental property leases as proof of residence. I don't know that I ever saw a lease that actually listed all of the children on it. I'm sure there are some, but I tend to think that that's a sort of unrealistic source of substantiation on the IRS's part. Maybe it just differs based on what each state's form leases look like too. But in Illinois, the leases seldom listed the children. On the other hand, records for school or child care enrollment and attendance, frankly, report cards were a pretty good source of that if someone's got report cards. But really anything from the school that tended to show they were enrolled there, obviously that shows they lived in the United States. And also, they'll usually school records will have addresses listed on them, which will also go to attendance. And they're a third-party record, so the IRS likes to see that. Government benefit or assistance records, if they're a WIP recipients or something similar, those records might show that. Legal or financial matters is listed. That really means like guardianship papers or things like that, or reports to the court if you have to do status reports on status of the kids. Medical care or health insurance records. People occasionally showed medical records that showed that, we were taking this kid for treatment and reporting to the doctor our address was X. The IRS is ordinarily not going to say those are insufficient. So the relationship tests, a birth certificate obviously establishes parentage. If the child is adopted, then you need the adoption papers, if a foster child, the order placing them with the parents, or if there's a guardianship, then the guardianship order. Not the parents, but the foster family. And if it's a guardianship order. The residency test, you need to show where you live and the dependents lived. We already talked about showing where the dependents lived. For showing where you lived, the rental property lease or, a mortgage statement or something like that, it will do it. The support test there, this is sort of I'm trying to think of how to put this. So the support test for a qualifying child is not that you provided most of their support, or the person claiming the credit provided most of the support. It's that the child didn't provide most of their support. There aren't going to be too many situations where that's an issue. Still, to the extent that you can produce records showing that the parents, I'm sorry, I say parent, but whoever is claiming the credit provided a significant amount of support, that will at least allow the IRS auditor who's assigned to the case to check off the box and say, okay, well, I've seen something on this. But that's just not an area where I would expect to see significant scrutiny. There's also, as you'll see on page 2 of the form, information on how to prove dependents disabled if they're over 18 and you're claiming them as disabled. Or if they're a student, how you can prove that. I'll stay away from that just in the interest of ensuring that we have some time to get to questions. But that's there if it's needed in those sort of edge cases. And then, there's also some information about basically establishing that you're entitled if the child could otherwise be the qualifying child of someone else. It basically documents showing whether they resided with you, and, information about who the other person who could potentially claim them is. So those are sort of the documents the IRS would like to see. As I mentioned, on some level, I think the support test is probably not where the IRS focuses its efforts. Any reasonable substitute for any of these documents the IRS is looking for, they're going to accept. They laid out some of the most common ones, but there's always, just to give an example, if school records aren't available or aren't easily obtainable for some reason, if there's some sort of records of where the child was in daycare or something like that, notwithstanding that it's not on the list, the IRS is going to accept that as well. What they would really like to see, though, is third-party records so they don't have to just take the taxpayer's word for it. So that brings us to some further issues, and I think I said this at the start of the program, but these are largely issues where we got some questions before the program started and we wanted to include those, but they didn't fit a particular portion of our outline. So the first issue is I want to talk about what's called Form 8332. And this is the form you can use. It's almost always used in the situation where you've got divorced parents who agreed to split the credit a certain way. It allows a custodial parent who could claim the credit to give up the right to the credit or revoke the prior credit. And that allows the non-custodial parent to take the child tax credit. That is, I think, the one exception to the rule that someone who has custody, that you can only claim a child if they live with you for more than half the year. If the custodial parent executes a Form 8332, then the non-custodial parent can claim the credit. Need to be clear, this is an incredibly limited circumstance. It's only for use by parents. It only allows a parent to take the credit. If a parent isn't, you can't use it to allow another relative to take the credit. You can't use it in the situation where you've got two people who aren't the child's legal parents. You can't use it in a guardianship situation where the guardians are split up or multiple relatives are taking care of the child or something like that. So it's important to know about, but the application is limited exclusively to parents. And as I mentioned, it's almost always in the context of divorced parents, but there are probably some situations where, parents who were never married or parents who are still legally married but filing separately might be taking advantage of that. So that's one issue. Another issue is we got a question about what to do to get the 2021 advance payments if a parent has been claiming the credit improperly. The situation, and I wasn't 100% clear about the exact situation that was being asked about. So if you're the person who sent that in and you don't think what I'm about to describe addresses it, please feel free to use the question box or shoot us an email afterwards and we'll try and address the situation as you meant it. But what I understood this to be is a situation where, say, the parent didn't have custody in 2020, but was claiming the child as a dependent. And the question was, how does the guardian go about getting the credit for 2020 and the advance payment going forward? So what you would need to do in that situation is you just need to, as the person who was, the answer was, should you go about doing it? The answer is probably yes. And how do you go about doing it? And the answer there is if someone else was claiming the credit, but you were the person entitled to it, you should go ahead and amend the prior year return or file it if you didn't file a return in that year to claim the credit. When the IRS sees that there are duplicate Social Security numbers, it's going to reject the credit, but they'll send an inquiry and you'll have an opportunity to prove you were entitled to the credit. So that's the note about this will probably not be resolvable without paper filings. You probably also in that circumstance can't get the advance payments in 2021. And the reason for that is really twofold. One, I kind of doubt the IRS is talking within itself, what's the word I'm looking for, efficiently enough to pick this up. But the other thing is just the speed at which the IRS operates. If you were to amend a 2020 return now, and there was a problem with it the IRS had inquiries about, they probably wouldn't resolve it until at the very earliest, the end of 2021 now. And so it's more of a timing issue than anything else. I do want to note that that, doing that and proving that you're entitled to the credit probably will result in the IRS going back and assessing penalties and interest to the parent who wasn't entitled to the credit. There may be some situations where, in light of that, depending on whether they can actually pay it back or not, you want to work out something informally and say, hey, I was entitled to this. Can we settle the dispute? They may not be in a position to pay it back. You may or may not be concerned about whether they're entitled, whether they are charged penalties and interest by the IRS, but it's a consideration. And then the other issues that came up, we got a question about where in early 2021, the mother of a child or children passed away and the aunt is now taking care of them. The mother before she died, received a preloaded credit card with stimulus money on it. And the question is, if the advance payments are loaded to that card, can the aunt use them? The IRS doesn't have guidance on this situation. They actually have a surprising amount of guidance about what to do when a child dies, but very little about what to do when there's a deceased parent. But the answer is probably not, and there are a couple of reasons for this. First, the card is likely personal to the decedent, and technically nobody else should be using it. So there's that. But second, the advance payments are for the parent's 2021 credit. If the aunt is the one who'd be entitled to the 2021 child tax credit, and she would be based on what we understand, when the parent's final return is filed, it won't have the credit on it. This isn't a situation where the portals we described and that are linked appear to give you a way to guarantee you'll get the credit. The indication we got was the aunt had tried to update her portal and it told her those SSNs were claimed by someone else. The one thing I would try is that the IRS does have a procedure where you can notify them of a taxpayer's death. You send a copy of the death certificate to the service center where they would file their return. That might cause them to realize that, the payments, basically those SSNs aren't going to be claimed on that return. But I think that's probably I haven't seen anything indicating for sure that that will work, and that's probably an overly optimistic assessment of the ability of their different systems to talk to each other at this point. So unfortunately, I think the most likely answer in that situation is she probably won't be able to get the advance payments this year, and she'll probably need to just claim them on her 2021 return when she files it in 2022. Next is a situation where you've got 3 or more custodians. That's really how this should read. And maybe none of them have the child more than 50% of the year. If it's really true that custody is split among 3 people and no one has the child more than 50% of the year, then technically nobody can claim the credit. But note that 50% test, we didn't talk about this that much, but temporary absences, things like being away for school or things like that, don't count against the 50%. So in that situation, you really want to look and say, okay, well, if it's just weekends at grandma's, is that really a temporary absence and something we don't have to count? But if it's really truly that nobody has the child more than 50% of the year, then you simply can't claim the credit. And then finally, addressing the credit in the guardianship order, we were asked whether that's a good idea or not. As I think I mentioned, the IRS, it does not care and is not bound by what you put in a contract or a divorce decree or a guardianship order or anything like that. So from the perspective of getting the credit from the IRS, I don't think it helps. It probably helps a little if you could say, I'm this child's legal guardian. They're probably likely to consider that in deciding whether you substantiated your entitlement to the credits. But more importantly, I think if it's in there, it may help resolve disputes with other persons who could claim, or even if they couldn't legally claim them, like are trying to claim them anyway, like the parents. So I don't see any disadvantage to putting it in a guardianship order, never mind that it doesn't do a lot for the IRS. I requested and see that you guys have put in a bunch of questions for us, but I also see that we exactly hit our end time. So I think that what we'll have to do is respond to those questions offline. And I'll turn it over to Joe because we have 11 of them pending. So there's no way we're getting to those all if we stay a couple of minutes extra. But I promise we will respond to those offline. Joe, I'll turn it over to you to send everyone off.
Robert, thank you very much. Megan, you as well. And as Bob noted, there are 11 really good follow-up questions, some of which we touched upon, some of which deserve some follow-up. So we'll figure out on our end how to get answers to all these 11 and share them universally so that everyone can benefit from some of the questions that were asked. Again, they're all pretty darn good. So we'll figure that out on our end, which means Megan's doing an awful lot more work, Megan. But seriously, thank you all for joining us for this presentation. We hope you found it helpful. We hope it allows you to be put in a better position to help your clients. I think with addressing these follow-up questions, all of which are pretty practical in nature, the combination of the presentation and the follow-up responses should do that. Personally, I thank you all for doing what you do for our communities in the various states. And I hope that this information was helpful to you and your teams out there as you continue to do your good work. I want to remind you that for all of you who are seeking legal education, continuing legal education hours, that they are available. Again, just click onto the CEU icon below and follow that process as indicated. A certificate of attendance will be emailed to you along with the recording, as I mentioned earlier. And then we would ask you to take a short survey at the end of this presentation so we can continue to provide better webinar service to you and address any other questions. So on behalf of Bob, Megan, myself, the entire Husch Blackwell team, and Bob's dog, thank you all for joining us today, and good luck to you and keep up the good work. Thank you.